And also backing a no-rate cut from the RBA was fund manager Roger Montgomery, who joins me now here in the studio.
Hello,
now,
Ticky.
Roger, hello. I mentioned Philip Lowe and the coffee mug, half full. You're not feeling so optimistic. Why?
No, look, I'm an optimist. I'm an entrepreneur and a fund manager.
And you just won the sweepstake.
And I just won the sweep at the office. But I do believe the cup is actually half empty. Since the 1970s, every single time that the economy has slowed down, this is globally, we've implemented easy money. And that's done a couple of things. One, it's promoted overinvestment, and it's promoted overinvestment in the wrong things, usually speculative activity in asset prices. And the other thing that it's done is it's destroyed creditworthiness. And so when we look at overinvestment in, for example, housing in Australia, it's non-productive. It's not manufacturing, it's not reinvestment. And we're seeing this, the ASX 200 companies, for example, since 2010, their payout ratio in aggregate has fallen from about 55%. Sorry, the payout ratio has increased from 55% to about 80%.
Well, interestingly, I was interviewing Andrew Thorburn at NAB recently, and he was saying, no, their dividend is going to be maintained. I think the payout ratio was increasing because he felt that their capital was strong.
Well, their payout ratio is increasing, and this is what I'm talking about. The payout ratio for the top 200 is going up. The corollary of that, of course, is that there's less money being reinvested, and boards really have no incentive to reinvest because the yield curve is flat. So why would you take the risk of investing longer term? Why would you extend your duration when you get the same return for investing over the short term? So there's no interest in reinvestment. That means growth is low at precisely the same time that asset prices are at record highs.
What about the transitional economy away from mining? Because I note the RBA statement today said the large decline in mining investment is being offset by growth in other areas, including residential construction, public demand and exports.
Yeah, well, that's the most frightening thing that I've ever heard, because residential construction is booming right now. We have something like 600 cranes employed in Australia, which is more than in the major cities of the United States, developing high-rise residential apartments. That will eventually end because we're heading towards an oversupply situation. When that ends, that means 12% of our workforce is at risk. And I spoke to one developer in Melbourne and I asked him what would happen, and he said, I'll just get rid of 20% of my staff. So if 12, you're talking about 3 or 4% of the Australian workforce being unemployed in the next 24 months if the residential construction boom ends, and it will end simply because we're heading to oversupply. And just remember this, you can't have oversupply coinciding with record high prices. We talked about this a few years ago in iron ore. It's the same thing in property in Australia. It's the same thing in shares. The ASX 200 PE ratio, excluding banks because we use price to book rather than price to earnings, record high. The materials index...
For the markets, though, or an investor is, where do you get off? Because, I mean...
Well, unfortunately, the markets are all correlated at the moment. You've got bonds correlated with equities. You've got property correlated with equities and bonds. There's really nowhere left to hide other than cash. But the reason why no one wants to go into cash is because it's earning such a poor return. My view is 2% is a darn sight better than minus 20.
And what about the slow unwinding that we're seeing now in terms of this correlation and bond yields potentially actually ticking up a little bit?
Well, I know bonds are ticking up. In my private account, I've actually, the last time I ever spoke publicly about my private account, it was shorting the Australian dollar at $1.02. I've now been shorting US bonds in the United States, and I'm already up about 40 basis points. I don't know whether the interest rates in the United States will rise quickly or slowly, and I don't know whether they'll be 50 or 100 basis points higher in a year's time. But I know that if you and I hibernated for 5 years, we will wake up and rates will be higher, and that will have enormous implications for asset prices around the world, which are currently at record highs.
All right, Roger Montgomery, thank you very much. Enjoy your sweepstake at least.
Thank you.